So we ended up with a teacher who was an assistant principal, a teacher who then went military and
Hey, but my watch at 6 p.m. I'll call this special meeting of the Somervell County Hospital District to order. It's Tuesday, May 24th, 2016. Show that all board members are present with the exception of Dwayne Griffin, who contacted me earlier and he'd been out of town and said he wasn't going to be able to make it. Item number 3 is to hear a report and if necessary take action on financial statements and independent auditor's report from Conley and Company for fiscal year ended 9/30/2015.
I'll introduce Jeff Graham to us. Jeff is the audit partner with Conley Company, and then also want to introduce Jeff Duncan. And Jeff is the on-site auditor. We spent quite a bit of time with them, and last year and this year, as a matter of fact. So we kind of know him quite well. But Jeff, I'll just let you take it over and go from here. We'll take it back.
Lots of paper.
excuse me. Excuse me.
Well, some of it, that's just let me say that. And I handed out 3 reports, and I'll just tell you which one it is right quick before we get into those. The one with the moon on it here is what we'll really be talking about as far as financial information. That's your main report. Then you have a second report that looks like this. This is the required communications, our required communications to the board. We'll go over that briefly after we get through the numbers. And this is going to highlight any adjustments, any past adjustments. I don't know if you have any past, maybe 1 or 2 little ones. And past adjustments are adjustments that we don't post. But we want y'all to know about the adjustments so you can see what we passed on. Usually it's accruals that rotate, the next month anyway, during the next month. Also, if we had any disagreements or any problems with management, we're required to report to we didn't. And then also we attached the representation letter from management to this report. So you've got lots of stuff in this report. I'll go over it briefly here in a minute. And the last thing is the stapled, and this is just our management comments, and we'll go over that too at the end as well. The spares. I believe the spares right here. This way, okay. The spares. Anyway, we appreciate y'all taking the time. I know we'll call it a special meeting. Get us in there, have us present. Don't mind if I sit down. We got too much stuff to spread out. But healthcare continues to be challenging, and reimbursement is just, over the past few years, has been a real challenge, and it really has. You've had some things, UPL has kind of been up and down, for all hospitals, if you're going to get it or not. Well, so now it's UC or whatever else they call it. They split into 2 different payments. And also your electronic health incentive payments, those are kind of winding down. But that over the past few years has really been, benefit to a lot of community hospitals. Without some of those things, it would be really tough. But I'll just go through the report and then the numbers. If y'all have questions, please stop me along the way. I know you're just looking at 1 year here, 9/30/15. And a lot of this stuff I'll tell you, I'll compare it to prior years. So I know you don't have that number in front of you, but I'll just kind of tell you the variances between years. And on page 1, it is a clean opinion at the bottom of page 1. So really what that means is everything's in accordance with GAAP, basically is what it's saying. And that's a clean opinion, that's what you want. If you had the next step would be a qualified opinion, would say, well, everything's in accordance with GAAP except this, which you don't have that, so that's no problem. The last level is a disclaimer. Like for instance, we couldn't get enough information, we just disclaim an opinion. So this is the highest level clean opinion. On top of page 2, I want to point out too, we did add an emphasis paragraph. And just to go over what this really means is when basically your financial position, we wanted to emphasize that because really you're having current liabilities that exceed your current assets right now. We'll talk about that here in a minute. A lot of that's because you have some debt that's come due. Actually in May, I think there's 6 of those, and one of them was February. Also, you had some losses the last 2 years, and that's what we're going to address as well. What was the last thing? I know you have some other funds out there, potential property tax funds that we're not sure when or if it's going to come to the hospital, and hopefully it comes pretty soon. But that's really the question still out there is will that transpire and will that happen? We'll go over some of that here in a minute. We did include the emphasis paragraph. I want to point that out to you. Page 3 to page 7. I won't go over that. That's a required section. That's required supplemental information for GASB, and really that's just a summary of the activity over the year. But I like to start on page 8 and 9. And page 8 and 9 is your statement of financial, statement of net position. And this is a consolidated look. So you've got the hospital, and then you've got the 501A, both consolidated. And your nursing home, really, there's nothing there anymore. So that investment in the nursing home goes away. That's consolidated out. There's nothing there on the nursing home side. So really, it's the hospital and the 501A. If you look at the current assets, the first line, your cash and cash equivalents, $300,000. Last year that was right at $600,000. But you really got to look on page 9 too, where you see about 3 lines down, outstanding shares in excess of bank balance. So really, when you net those two, your cash position is negative. Really, it's negative 130. And in 14, it was right at 600,000, 608. So you can see your cash position, between the years has decreased. And the accounts receivable, the next line item, 2.3, that's really pretty similar to last year. Last year it was right at 232. In past years, we've had some pretty significant adjustments in that area. I don't think we've had them in the past few years, which the hospital's done a good job of tracking that. And I feel like we're pretty conservative on that. That's the big deal in healthcare is the receivables. And we're really taking a look at, well, what are you really collecting by payor class? And then we're starting there, and you're cutting it off on the end and saying, okay, but after it gets past so many days, for these outliers, we're going to allow for that too. So it's really a conservative approach of ensuring that allowance is correct as far as what you got on the books. Inventory decreased a little over $100,000 from last year. I think a lot of that was in the surgical area, if I remember correctly. Other current assets, a lot of that's prepaids and others. That was pretty comparable last year. And then your capital assets, last year was 19.7, this year it's 18.4. You did actually have a few things you purchased this year, but what's decreasing basically is your depreciation is more than what you purchased each year. You had some remodel, I know, the Granbury location. I think you also bought some security cameras, maybe 5 or 6 of those, which in total were pretty, that was $6,000 a piece, I think, or something like that. And you also bought a few pieces of equipment. And of course, the remodel was funded with the loan from Interbank. So that didn't affect your cash per se net. Just to keep that in mind as well.
Jeff, that remodel was actually downstairs.
Oh, it was down, okay.
Year 15 is the one downstairs.
Okay, that's right. And that, 194,000, something like that, okay. Yeah, we got it. So the rest of that difference really is depreciation. So you're getting a little over $1.5 million, I think, in depreciation a year, something. 1.5 million in depreciation this year. So that's probably going to continue to decline unless you have some significant increases or purchases of capital assets along the way. Overall, your total assets decreased from about 24 million last year down to 22.2. So that's where we're at this year as far as total assets. Page 9. Page 9, if you look at your current liabilities, and that top line is really what we're talking about as far as maturing debt. That 1,142,000 or 143 is the interfirst debt. You've got the $500,000 line of credit. You've got the refi 494, which was from I think another bank. You also got a renovation 149 for the renovations you did as far as that debt. And I see that's on your agenda. So, but technically all of that is due, within a year, especially as of 9/30/15. And the current portion of bonds payable 315. Last year's 300. That just goes with your bond schedule. Again, you're going to see that current portion up there every year. We talked about the next line, outstanding checks. Accounts payable. Between accounts payable and the outstanding checks in excess of bank balance, we saw an increase there as well, about $600,000 between those two line items. Now, you did see a significant decrease in accrued expenses. So that somewhat offset itself between those two categories. Accrued expenses decreased. A lot of that was making payments on your payroll tax liability that you have out there, and so as that goes down, your accrued expenses should of course decrease. Payables have seemed to be higher like these last 2 years, I think, than they typically would be, or higher than, let's say, 13. So again, that's a challenge, is getting those down and getting that excess checks or outstanding checks in excess of bank balance down as well. That means you're going to put more cash on the left side. Overall, your notes payable increased about a little over $500,000. So if you take all the new money you got, and really that new money was really line of credit. If you really think about what went in and what went out for payments, $500,000 was the new line of credit you had. So really that's what your debt increased when you net everything out, as far as payments and everything. Let's see, anything else? As far as total liabilities, last year it was 17.9. This year it's 18. So your total liability didn't increase significantly. What happened was more shifted up top into that current portion. And if you really look at that current ratio, you want that current ratio anytime. Y'all are all probably aware of all this, but the current ratio needs to be over 1. Over 1 means you've got enough current assets over here to cover your current liabilities. And right now it's 0.65, I believe, with 15. 14 it was 0.86. So you see that decrease, but the predominant reason was that interfirst debt that came on the books, and now it's due. So that was a big part of why that ratio went down, because that debt was shifted up into that current portion, or actually it was new this year, I believe. Then on page 10 is your consolidated statement of revenues, expenses, and changes in that position. Again, this is consolidated. If you'll just flip back real quick to page, let me see, 31 and 32. Just to give you an idea, 31, the first column, of course, is the hospital, and the second column is nursing home, which we don't have any activity. And then the first column on page 32 is the 501A. So, you can really see where your deficits are occurring. Now, you can't say, well, it's all the 501A. Well, you probably get a lot of ancillary services for the hospital from the 501A. But, this is really the challenge, I think, going forward is do you have costs there you can reduce? Can you operate that more efficiently? Is it going to affect the hospital significantly if you do? I think all these things you need to take into account. But it is a lot of dollars that you're spending in the 501A. But again, that may create a lot of dollars on the hospital side. So you need to keep that in mind as you're making decisions as far as reducing expenditures if you have any room there. Then back on page 10. Back on page 10, really the top of 10, your revenues, really your patient days were down 7%, but your case mix was so much better, really that your average revenue per visit was higher. So, net, you increase those top three items, $225,000, which is a very, very positive change. So, that case mix is important. If that improves, that means you're getting reimbursed more, basically, is what it comes down to. So it depends on the procedures and type, a lot of times, maybe sometimes, but a lot of times it's the procedures. The $225,000 up top that you increased, which was, really good, considering you had a decline in patient days overall. Those other operating revenues, that next section, that deals with your electronic health records incentive payments, and also your UPL, which is now uncompensated care, I believe is what y'all are under as far as what they split it out to. Really the big difference here is the electronic health records incentive payments. You've got $263,015. Last year you had $790,000, so that's it's $500,000 that decreased, which is, cash out of the hospital or cash out of the system, right? The UPL, if you net it, last year, actually this is a net number. Last year I think we grossed it up, but if you netted the 2 years, it is really only like $10,000 difference. So your UPL or your UC payments were pretty similar between years. So really in that section, it's the electronic health incentive payments that were your real significant change. So that went down about 5, but your overall revenues went up about 2, so you split them about 250, the difference there as far as the change. And operating expenses, a lot of your operating expenses actually decrease. So, I can see that you're looking at those expenditures, and I know you're cognizant of that. Really the one that went up is salaries. And really the salaries went up on the 501A side. The hospital stayed pretty flat or actually decreased a little. So, as you add physicians, there's more cost to that, and I know you'll have to look at that, and how does it affect the hospital, how does it benefit the hospital, what are the costs versus the benefits of that. But that's most of your increase in operating expenses. They went up about $350,000, and it's really, you can track it all back to the 501A is where those expenditures occurred. So your operating loss, $5 million. Last year it was $4 million. So really that increased or decreased $1 million, but you got to take out $400,000 because we netted that UPL below. So it's really $600,000 decrease between the years as far as your operating loss. Then non-operating income expense is that's where your taxes are going to fall in here or be slotted. Your interest, any donations you get. Interest decreased a little bit. The tax revenues increased a little bit. So those pretty much offset between those two categories. Miscellaneous is that actually increased about $180,000 net from last year. And some of that was when you had your payroll taxes, when you set up the payments on that, some of that interest and penalties was slotted down here in 14. You don't have that this year. So that really increased, or that whole category increased about $400,000. So that helped too as far as the bottom line. The net deficit of revenues over expenses from operation actually decreased $282,000. So when you see the slight decrease up top in revenues, when you look at your operating revenues, less the decrease in your electronic health, plus the slight increase in your expenditures, less the slight increase in non-operating income, that's basically the net of it, $282,000 decrease from last year. As far as your net, I call it net income, it's deficit revenues, what it is. Page 11, I want to just go over this real briefly. And this is your cash flow statement, and really, I would say probably for a district, you really need to combine those top two line items, because you can say, well, net cash used in operating activities, and then the other non-operating income, a lot of that's going to be your taxes. So you got to kind of look at those two line items. So you're producing a little cash, but if you look at that next section, that cash flows from capital and related financing activities, that actually decreased about $700,000. And that's also, you got to keep in mind, that's also getting in $500,000 of cash from the line of credit, because that was new cash that was brought in. So what I'm saying is, without that be 500,000 more in the negative. Overall, your net decrease in cash was $324,000 from 14 to 15. And as far as the notes, starting on page 13, there's lots of notes, kind of stuff, lots of stuff to put in. But if you look on page 16, if y'all see any other notes you want to go over, glad to. But starting on page 16, and this deals with new standards coming out, and really recent accounting pronouncements, the third section down. But it's the first item deals with revenue. I won't read all this to you, but bore you to tears probably. But there's some new revenue recognition standards coming out, and the real scare initially for healthcare entities was they were talking about putting self-pay on a cash basis. So in other words, as a hospital, you couldn't recognize any self-pay income until you collected. Now I think they've since reversed that, and a lot of that will not happen that way most likely. So this standard is going to be a big deal when we're trying to figure it all out as accountants. We'll have lots of interpretations and all that as we go. It's still several years before it's going to be implemented, but it's such a huge change. I don't think it'll be implemented for y'all until 18 or 19. So, but you want to start getting ready and see how that's going to affect the district, as you get closer to that. So you'll want to, we'll keep you apprised as well as soon as we know more stuff. And a lot of that dealt with, they were trying to combine the U.S. standards and international standards, and after about 10 years, they've gotten two things done. So you can see that, and I'm sure there's lots of complexities. And the next item deals with simple measurement of inventory. Again, I don't think it will affect you significantly. And then the third, on bottom 16, top 17 deals with leases, and this will affect everybody. And this won't be effective until 19. But what changed was before you could have an operating lease, which was never shows up on the books, which hospitals have lives, and then or you could have a capital lease. And a capital lease is such that you book it because it's either the terms or so long, or the amount of the lease is a percentage of the fair value of it. But going forward, all leases will be booked. So all leases will be booked as an asset or a liability. And that's going to be a significant change for a lot of industries, and healthcare is one, because there's a lot of equipment that's leased, consistently. So that now will show up as an asset and a liability. There's also another standard out. The last little paragraph there deals with reporting standards as far as for not-for-profits and healthcare entities. And some of that may change the way, like your cash flow statement is reported, maybe more of a direct approach, which would be cash in, cash out. Really nothing that would change your numbers, but it will change a lot of your format of some of that, as that applies to y'all. Page 18, note 3, just gives you a good summary of your capital assets, and that'll show you what you added. The 194, I think we talked about that. That's your renovations, and the 42,000. This is in that addition column. Is your security cameras, and I think one piece of equipment you purchased as well. Right below that, note 4 is your debt roll forward. So this gives you what you started with, the additions that came in as far as new money, and the reductions as far as payments, and your balance at September 30, 15. Gives you a good roll forward. Right below that is a description of the notes. And the due dates, etc. Page 19 and 20 that shows you your bonds. On page 20, you've got a bond maturity schedule. It shows you your bond payments each year as far as broken out between principal and interest. And that 315 up top, that matches your current liabilities back on page 9. That's the amount that should be shown. The rest of these are probably probably seen a lot of these. I don't think there's anything new. Let's see if anything. Note 14, I would say on page 24 and 25. Again, that just reiterates, kind of what we talked about, some of the challenges as far as your financial position right now, and really the plan is already in place. I know one thing is the tax rate's already been increased from voting on the leave, so that's one change. And also you've got some, as far as renewal of debt, I think that's probably on the table, and reduction in expenditures, you know, all that needs to be on the table as far as to get that back in the position you need to be. Okay, any questions on that report? I'll go to this one unless you guys want to go into more detail on that. And this is it's the required communication. It says report to the board of directors. Yeah. And I'll just point out just a few things in this report, and the page numbers. You know, if you look at page 3 and 4, those are our required communications. And really, there's nothing unusual here that we can just talk about. There's really no significant or unusual adjustments, no alternative treatments. In other words, you know, we weren't approached and said, hey, could we account for this differently, or you know, something of that nature. We'd have to report to you. No disagreements. We talked about some of the basis stuff. Audit adjustments. If you'll turn to page 7. And it should look like this, kind of a little schedule. And again, I'll just say, I mean, in previous years, this has been a lot longer, I know. So it's you know, the county is really, you know, it's really down to a few adjustments each year, is what, large ones. You can see what we adjusted. The main ones were really depreciation expense. That's the 637, which is a non-cash event for y'all, but that's, you know, it's still something that had to be booked. And then we would classify the credit balances at 350, 857. That's really just transferring it from the asset to a liability. Because if you don't take those credit balances out of that AR balance, it may understate your allowance. Because what you may say, well, 0 to 30 days is 60,000. When you take out the credits, it's really 100. So we're taking those credits and putting those over on the liability side until they're worked, and then they can be cleared or whatever needs to be done with us. And a couple other adjustments, you know, the Medicare and Medicaid is usually from the cost report, so that's not a big deal. And then we did reclassify one cash clearing account, which I think the purpose of it was gone, and really it was just a liability left, and we just reclassed it over to liabilities. So again, those are balance sheet adjustments. If you want to know what affected your net income from what you were seeing initially, it's all the way to the right. If you see that, basically you can take the expense column less the revenues. So basically 620 is what we added to the loss, you know, from our adjustments, and most of that again is depreciation. And then the 501A, we only adjusted depreciation. That's the only thing we had on the 501A. Then page 8, these are uncorrected misstatements, and this is what I wanted to point out is these are adjustments we did not post, but we still want to show y'all, you know, these for the current year. And nothing here is material, or nothing here would affect anything significantly, but we still want to point that out to the board that here's what we passed on. Most of these will typically just affect the balance sheet side. Let's see, it's okay. Then at the end of that report is the representation letter, so y'all can look at that if you want. It's pretty detailed as far as, you know, all the representation, and that's the representation for management back to us, that everything is disclosed, etc. Any questions on that report? I got one more left if y'all want to go over the stapled one. The stapled report as far as the comments. And just to preface this too, there's 3 levels of comments, okay? When you have, there's a control, what we call a control deficiency, and then the next level is a significant deficiency, and the next level is a material weakness. So the material weakness is being the more serious, I guess, comment, or the comment that could affect you materially. That's the significant deficiency is in the middle. Significant deficiency or material weakness, we're required to report to you in writing. So if we have either one of those, we have to report those in writing. But we choose to report everything in writing, so you'll have control deficiencies in here as well as, I think we had one material weakness, and it dealt with the financial condition, so. But again, we're reporting all these to y'all, but I just want to point that out, because the severity of the control deficiencies obviously are not as significant. And you had some comments, we just followed up the prior year comments, and really all these that weren't implemented or, I mean, these are control deficiencies again. Again, you've got to look at your cost versus benefit of doing some of those things, but you know, still want to point out. Payroll liabilities was in process, and then the revenue cutoff was implemented. The comment we had in 14 on the revenue was some timing differences as far as when it was being posted. So, you know, really I think the more important two items have been addressed. And then on page 2, these are comments we had from 15. Then we had one pay increase for an officer that you just want to make sure you have documentation to file. It was nothing that we considered a fraudulent event or anything, but just for your documentation, especially for your officers, your higher level employees. And then the 403B deferrals, you know, also, you know, you want to ensure that those are paid timely. The Department of Labor has been really adamant about that in the past years, and CPAs are really getting hammered. I don't know a better word, but that's a big deal. And really, it needs to be paid as soon as you can segregate it from the regular payroll, but no later than 15 days following the month that it was paid. So you just want to make sure those are paid timely, so you don't have any concerns with the deal.
I might make a comment on that. By the 2016, that's being met.
Okay.
Yeah.
I think we had just 3 instances where they're over that, but we just wanted to, you know, emphasize that the DOL is very involved in that right now. And then the next item, the fixed assets, and we cited this as a significant deficiency because it does have the potential to have a material effect. And really, I think what that deals with, well, we did have an adjustment for $600,000 for depreciation, and you know how we can work, I guess, with Becky as far as helping to make sure all those fixed asset ledgers are correct, which y'all are seeing those every month. I think that's beneficial to everybody. But again, it's a non-cash event, so I'm not sure, that's up to y'all as far as the significance of that and what y'all want to do with that. And the last item deals with financial position, and really, you know, what we're saying is, you know, we've talked about these things, you know, you've got current liabilities up here, you've got some debt that's maturing. All these things really need to be looked at. And expenditures, you know, can you reduce expenditures where you can? Really to get the system back to where it needs to be. And you know, get to a position where you can start building some cash reserves. That's really going to be key for the future. What else? Anything else, Ray, that I think it's cover? If y'all have questions, I'll be glad to answer them.
Any questions or comments from the board at this point?
I think it'd be appropriate to take action to accept the audit report.
Yes, I have a motion to accept the report as presented.
I'll make that motion.
Okay, we have a motion. Do we have a second?
I'll second.
Okay, I'm not sure who got that.
I'll second.
Okay, Dr. Flossie. Any discussion? If not, all in favor, raise your right hand. Okay, 6-0. Next item, number 4.
Thank you, guys. I really appreciate it.
Note that Dwayne Griffin has now joined us. Item number 4, discuss and if necessary take action on proposal from Interbank, I guess Ray just left, to restructure and renew existing loans. I'm going to turn it over to him. Yes, thank you, sir.
Thank you. bring you up to date a little bit. As y'all probably know, we've had really 4 notes at the interbank. 2 of them are notes. One of them is for the electronic health record, and the other one was for the renovation downstairs. We paid those on a monthly basis, and we're current with those. But they did mature in May. The other was a line of credit, and the other one was a loan for a UPL program. Let me just say this, that we've had some discussion with the bank from time to time about these notes. They're matured. But let me just say that the bank came to us, last Monday. Mark Martin, who is the president of the Interbank in Stephenville, called Friday, asked to make an appointment to see me. Always a little anxious whenever the bank calls and wants to make an appointment to see him. But he came in and they had talked as a group or as a bank, and they came to us with a recommendation and a proposal. And their recommendation and a proposal is that they would that on the two notes that we're paying on a monthly basis, we paid those down some. They would re-amortize those on a 5-year basis and set up a note payment on both of them, which is about $2,000 less than we're currently paying. One would be the monthly payment on that would be about $10,850, which they would renew until February of 2017. And the reason for that is that in February of 2017 we will receive another payment, or should receive another payment for taxes. So there will be some tax revenue come in. We know what it will be from the homeowners and the business owners. We're not sure what that will be from Lumen. But then they went further than that, and they proposed that the other 2 loans which had matured earlier, one of them in January, the other in February, that they would refinance those. They would roll the interest into that, and then set up a monthly payment. We paid only interest on that, and that would be a payment of about $23.64. So the total for all notes would be about what we're paying currently. And let me just say that they also made a statement that they understood some of the issues that we're facing, and that they wanted to be a bank that supported supporting the local hospital, and I appreciate that. If y'all are in agreement with this, I would like for y'all to approve the refinancing, and then authorize me or Ron to execute these notes on our behalf. And the other notes, all of them would be due on 2/17, February of 2017.
What is the total amount, Rick?
A total amount for the 2 would be the $793,123 would be the 2, the line of credit and the UPL would be a $793, and the other 2 for the electronic health record and for the renovation would be $575,028. About 1.23 million.
What did they do to the interest rate? Does it stay the same? Or?
Yes, it's 3.25. The way they've done that is that we're a nonprofit entity, and they charge us a nonprofit rate.
Any other questions or comments from the board?
That was a very nice gesture on their part.
Okay, if not, do I have a motion to authorize Ray Reynolds to work with the bank to restructure and renew the bank loans from Interbank?
I'll make a motion.
I'll second it.
Okay, motion and second. Any discussion? If not, all in favor, raise your right hand. 7, none opposed. Okay, that completes our agenda for tonight. Item 5 is adjourned. I have a motion to adjourn. Make a motion to adjourn. Dwayne Griffin makes a motion. Second.
Second.
And Parsons. I assume there's no discussion. All in favor? Raise your right hand. 7-0.
Somervell at their regularly scheduled board meeting, evening at 7 p.m. to be here. And those agendas are, if you received by email, also they're in the mail to you. Thank you very much.